Today we'll learn G2G framework of Ajay Sharma Sir. This is very important in stock market understanding of share prices, how they behave, how they increase and how they decrease. If one is looking for some fundamental analysis video, this is for you, and I'm going to explain you each thing with lot of explanation and hope you will find this video useful. So Ajay Sharma Ji has shown one G2G framework of how share prices increase, become multi-bagger and then starts to go down. Like in current market situation, most of the companies are facing the situation where share price is going down. So what happens exactly, we'll try to analyze. So first of all, you understand that the share price is basically the combination of two things, P ratio and EPS. This is the multiplication of P ratio multiplied by EPS. EPS is nothing but the earning per share. Suppose a company is earning 1 lakh rupees and he has 1 lakh shares. So 1 lakh divided by 1 lakh, 1 rupee per share that company is earning. 1 rupee per share. Now suppose that company is earning 5 rupees. One company is there which is earning 5 rupees behind per share. Okay. And market is giving EPS P ratio of 15. P ratio market is giving 15 and company is earning a EPS of 5 rupees. So if you multiply 15 by 5, then you will get a result of 75. That is the current price of share, 75. Now how it will increase? Either EPS has to increase or P ratio has to increase. Either of this thing or both of this thing happens, the share price will increase. Suppose EPS will double 2x and P ratio will not increase, then the share price will also 2x. It will double. But what if EPS also 2x and P ratio also 2x, then the share price will be 4x. This concept is the basic theme of stock market. If you learn this, your entire share market will be clear. No need to do any full course of this paid course. Okay. So try to analyze this. What we want is EPS also increase and P ratio also increase. Then only you will get multi-bagger returns, because your share price will start to grow like rocket, 4x, 8x, 16x, like that. So next we'll see that when the EPS of 5 will become 10, like EPS has now become 2x, EPS has grown to 2x. The company which was earning 5 rupees behind the share, now that company is earning 10 rupees behind the share. 2x of the earning. So earning has become 2x. Now market will think that this company is growing its EPS by 2x. So we should give the company higher P. So the P ratio, what the company was getting 15, now it will get a higher P of 25. Suppose 25. So 25 multiplied by 10, the share price you will see is 250. This is called PE expansion. Generally happens in bull market. All companies which are having EPS growth gets a PE expansion. P will expand. When P will expand, your share price will get more reward than EPS. By increasing the EPS itself, share price will increase, but because that EPS has grown, market will give your share higher P ratio, so your share will more gain. It will, the growth will be higher, 2x, it will become 4x. So this is how share price increases. So when again, if you see that now the EPS has gone to 15, the EPS which was 10, now it has become 15. And market has started giving your share the P ratio of 35. So with this 35 and this 15, your share price will be 525. Very good. Now again next year EPS increased to 20 and market has given again increase the P ratio to 50 and your share price will become 1000. Now it is, the growth is now exponential, because share is growing at a very fast rate, because P ratio also your share is getting very high due to performance growth which it has shown in EPS growth. Now again you see EPS is increased by same 5 rupees and your stock is now getting a PE of 70. Stock price has become 1750. Now it is a very great valuation. Anything above 50 PE is great valuation, not the good valuation. It's a great valuation. And the great power comes with great responsibility. What is that great responsibility? To maintain its EPS growth. If the company will start decreasing the EPS growth and it will not perform as per the expected EPS growth, then market will correct its P ratio. Market will start giving lesser P ratio. Here you see, next year the P growth, the EPS growth has decreased. The share which was, the company which was earlier giving a 5 rupee EPS growth, now it has given 2 rupee EPS growth. 27 rupees only company has earned. Even though EPS has increased, EPS has increased from 25 to 27. But in newspaper it will come that this share, this company has shown a higher growth, higher earnings, higher profit. You will think that profit has increased, so share has to go up, but the growth rate, the rate has decreased. Dar, if you Hindi, if you know the dar, like 5%, 10%, the growth has decreased. If the EPS growth has decreased, growth rate has decreased, then price will drop because of P ratio. Market will start correcting. This phase is called PE contraction. P will contract. The P which was expanding, now P ratio will contract. So whatever gain the share got because of EPS increase, now that will be subtracted by the P contraction, and your share will start correcting. This is the time you should sell your position, because now you don't know how many more years the share price will go down because of the P crash. Otherwise, one more thing is that bear market always correct the P's. The P contraction happens in bear market, like the current situation. So bear market actually corrects your P ratio. So all shares will correct P ratio, either its EPS is increasing or decreasing. In bull market, if your EPS will be less, growth will be less, your P ratio will be contract. So this is the time you should sell. Now you see the share price is correcting because that EPS is not growing. EPS is not growing with that phase. It's increasing but not growing with the same pace which it was giving earlier. So this is the phase where the companies become great to good again. Now at this phase you have to wait until again this will show the same EPS growth. That EPS growth, it will show sometimes. Some companies will again gain that power or management because of change in management or some new product. They will again start showing that same level of EPS growth, but you have to wait till that time. Then only you can again make the position. So you have to buy any share where the share is in the good to great phase, and you have to sell it when it is in great to good phase. This is the simple thing in share market. This only works. If you see any stock which has become multi-bagger, you will see that EPS was growing like anything. That growth was very high. In when that stock price started correcting, that was the time when EPS growth was less. Like Trent is the perfect example. You can go and check. It was giving a good EPS growth from last 3-4 years, and now this quarter the EPS has now come down. Sales growth has come down, and the stock P ratio was crashed by the market, contracted by the market. So this simple thing, if you apply in your share market journey, your things will start becoming very easy. This is a simple illustration. First the company become great, good to great. In some 4-5 years you can see where prices was very high, P ratio was very high. When suddenly EPS growth was less, the share price was again becoming great to good, in the great to good phase. So if you draw a 2x2 table and you put your stocks in this one of these four lists based on their business and valuation. Business means either your stock is good or great, like it is just growing that EPS phase, or it is not growing the EPS. Based on that you can consider good or great businesses. And valuation based is your P ratio is 15-20 or it is very high. If your stock lies in these two dabbas, in this two blocks, you can buy that stocks. If your stock lies in these two blocks, you can consider selling that stocks, because already valuation are very great, like very high. In bear market, always sell your stocks when p ratios are very high, because bear market contracts your p ratio and stock price crashes like anything. So always buy at good valuation, a great company or good company, but always buy at good valuation. Now what is good valuation? Good valuation is anything which is getting a p ratio lesser than its eps growth. Understand this line. If your eps is growing by 30% annually, eps growth is 30% annually, then your p ratio should be less than or equal to 30. This is what I called is correct valuation or good valuation. Suppose this is eps growth, this you can write in a paper and hang it near your table where you are taking your investment decisions. If your EPS is growing by 30% and P ratio is less than or equal to 30, then that is a good valuation. Otherwise, it is a all, if P ratio is already 90, 100 or 240, 300, 1100, then it is a great valuation and you should consider selling the stock, because your stock will not is in can be very dangerous when EPS growth will be lesser. You don't know when that will come. So it is always good to sell that at very great valuation. So this was the whole thing. Thanks to Ajay Sharma Sir, no credit of mine. His YouTube channel is there. You can follow him. You can learn lot of things from him. He came to face also with Vivek Bajaj Sir. I have learned this thing, and this video I will watch many times after some time, because I have lot of learnings. I need not to make notes now. This video will be my notes. And thank you Ajay Sir. Hope I will meet you someday. If you are watching this video, thanks for this concept. This was very easy concept, but nobody thinks about this like you. Like you presents the metrics, the data in very simple way. I cannot present, and I have just tried to explain to reach this, so that this concept should reach to more number of people. Like many people have not seen. I know whoever is seeing this channel may not have seen this theory or this concept earlier. So this was the main motive of making this video. So hope now you know this, so you understand this concept, apply on your earlier stocks which you have purchased and currently what you are having, or you know any multi-bagger, you see this G2G framework and then decide whether you have to work on this. It will be useful. Share it with your friends. Consider subscribing. All the best.